My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found in some of the biggest proprietary trading firms and hedge funds in the United States.
To many people, they think the market is like a casino, that trading is like gambling, that it is a zero-sum game where if one person wins, someone else loses. But what's so interesting is the markets are so much more than that. And this is important to understand if we're going to step into trading. In the early 2000s, I and my firm gained a reputation as being somebody who would trade new products that would help take new markets and make them successful. And many of the markets that people trade every day, I was either the first one to trade them, my team was one of the first ones to trade them, and we actually helped build those markets. Things like the S&P E-mini options, things like crude oil options, gold options, soybean options, 10-year note and 30-year bond options. Markets like this, we were the first ones to trade. As a result, by the mid and late 2000s, we were being sought out by people all over the world that wanted us to consult with them or wanted us to make markets in their products. And that was a very cool experience where we would have new exchanges that were trying to launch, and they would come in and they would pitch us about would we be their lead market maker. And by that point, I really had a good understanding of what would make a market work or what would make a new market fail. And so a key aspect of this is that we need to understand why a market exists. Markets exist for the commercial user who uses that market to hedge their exposure. And we talk about every market has a natural long and a natural short. The natural long is the party or the firm that just naturally owns the product, and the natural short is the party that naturally needs the product to run their business. So a great example we could use is corn. A farmer who grows corn is a natural long, and a food processor like a Tyson Foods that raises chickens or somebody like that, they are a natural short. They need the corn to be able to run their business. Now, if they use that market to hedge and to conduct business, that market will make it. If they don't, that market will fail. So I'm going to give you an example of a market that failed. In the 1980s, they tried to launch a diamond futures contract in Los Angeles. And they tried to provide price discovery for diamonds, which was a very dark market. Now, so they opened the futures contract, they were excited about it, they thought there'd be need for it, and nobody traded it. Nobody used it at all. Now, why was that? That was the case because the De Beers diamond cartel, the De Beers family, put out word that if anybody used this diamond futures contract as a means to hedging their risk, they were done. Absolutely done. The De Beers family would cut them off, and they would have no further access to diamonds. So because of this impending threat, nobody used it and the contract failed, okay? So one of the reasons I'm sharing this with you, there's a couple reasons. One of the reasons I'm sharing this with you is when people have a belief that the market is a zero-sum game, then a lot of people psychologically have a difficult time rationalizing why they'd ever want to be a trader. Because after all, what benefit am I to society if all I'm doing is taking the money from somebody else? This is a very common belief today. So if I win, someone else loses. Why would I want to do that? What's interesting about this, though, is it's actually not true. The market is not a zero-sum game. Every market has an intrinsic value. This is the value that market is intrinsically worth, and intrinsic value moves. It expands and it contracts. So one example we often use is we talk about Facebook. Now, it was not a great example last week. But if you look at Facebook was a concept that was developed in a dorm room at Harvard by Mark Zuckerberg. It was made up. This is so cool, okay? Because like when we look at companies, the value of companies is effectively created out of thin air. So he came up with the idea of Facebook, he grew the company, and then eventually the company went public. And it went public at a $104 billion valuation. Now, let's think about it. The day that Facebook went public, there was not somebody that lost $104 billion. No. That $104 billion of value was created basically out of thin air. So one of the really fascinating things is We look at our world and everybody is struggling with a mentality of lack. There's only a finite amount to go around and you better go for it. You better fight for it. You better be ruthless. You better be tough. You need to get yours and make sure nobody else gets theirs. These are things we hear all the time. When we go into, I live in Chicago, you go into Inglewood, you go to the south side, you go to the west side of Chicago, and you have people, you have kids getting shot over jackets, kids getting shot over shoes, okay, kids getting shot over $20. And why? Because the mentality of lack dominates the neighborhood. They think there's no way out. So if you want something, the only way to get it is to take it. It doesn't have to be like that. Money is an idea. Money is an idea that is made up. And when we start to understand this, it changes our life. It actually puts us in a place of empowerment because we can create money out of thin air. If you don't believe it, look at Bitcoin. Look at all these cryptocurrencies. They're just made up. And one of the great things I heard was that whenever you have a publicly traded company, publicly traded companies are legal counterfeit. They're legal printing presses. Because literally what you do is you come up with an idea, you print stock certificates, and then you exchange those stock certificates for money. Going back to our discussion about commercial users, the stock market exists for companies to raise money, to be able to effectively run their businesses, and the stock market exists for institutional investors to get return from owning businesses. The profits from running businesses, okay, so a company that makes money, those profits flow down to the shareholder, and institutions hold these companies and they use the profits from these businesses to be able to pay pension funds, retirement funds, insurance policies, all this sort of thing. So the natural long is the company. The natural longs are the Teslas and the Apples and the Nvidias and the Microsofts. And the natural shorts are the pension funds and the insurance companies, the mutual fund companies. Okay? So in this case, there is intrinsic value that is created. It's not a zero-sum game. So this is important to understand because this allows us to liberate our psychology and to start to think about money in very different terms. You all have a great night. I'm going to go climb in bed and get warm. Enough of this winter stuff. You guys have a good night. God bless. Bye.